Imagine it's September 2008. A 158-year-old bank has just collapsed overnight. $600 billion gone. Retirement accounts wiped out. Millions lose their jobs. But what if I told you the roots of this disaster began with a lie so simple you could fit it on a billboard? Why rent when you can own? Fast forward to 2002. The US is still recovering from the dot-com crash. The economy's reeling from 9/11 and Wall Street is jittery. But the Federal Reserve has a plan. Slash interest rates nearly to zero. Suddenly money is cheap, borrowing is easy, and a new American obsession is born. Buying houses. Congratulations, you're approved for a $500,000 loan. But we only make $40,000 a year. No problem. Adjustable rate, balloon payment, ninja loan. Ninja? No income, no job, no assets, no problem. In the early 2000s, home ownership wasn't just about shelter. It symbolized success, security, status, and the American dream. The message blasted from every TV ad, billboard, and mortgage seminar was the same. Why rent when you can own? Banks couldn't agree more. They started throwing money at people like it was a game show, and everyone was a winner. Enter the subprime mortgage, a fancy term for loans to people with bad credit, shaky income, or little understanding of how loans worked. Bad credit? No credit? Living in a van, you qualify for a luxury condo. Should I be worried about paying it back? Not your problem. If you default, we'll just sell the house for more. It was a housing gold rush. Prices soared. Neighbors bragged about their homes doubling in value in 6 months. Even part-timers at McDonald's and baristas with $5 in savings got approved for mortgages. And the rules? Thrown out the window. Traditional lending standards were too slow. Risk assessments? Too boring. Down payments? Optional. If you had a pulse, you had a mortgage. Houses were bought like pizzas. Loans printed like monopoly money. Mortgage brokers cashed commissions faster than they could say bubble. Behind it all was blind faith that housing prices would always rise. Because they always had, until now. But beneath the open houses and granite countertops, one question lingered. What could possibly go wrong? Spoiler: everything. By 2005, buying a house wasn't about settling down. It was about flipping fast and cashing out. Real estate wasn't shelter anymore. It was a get-rich-quick scheme. I teach phonics by day and buy condos by night. Just bought my third home, 0 down. Here's your latte, sorry for the delay. My bank just called to offer another penthouse. This wasn't investing, it was mania. Buy, flip, profit, repeat. The more people joined, the higher prices climbed. The higher they climbed, the more people piled in. It was like trying to douse a fire with gasoline. Everyone had a match, but beneath the red-hot surface, rot spread. The subprime loans everyone gorged on. They were garbage, risky, barely verified, often fraudulent. Wall Street, though, had a trick up its sleeve. It bundled all those toxic loans, slapped a label on them, and sold them to investors as safe. Introducing mortgage-backed securities, now with 80% more lies. How do you turn trash into treasure? Simple. Get the ratings agencies to call them AAA. This one's got bankrupt baristas and unemployed gym rats. Looks good to me. AAA. What they didn't advertise was this. Those same ratings agencies were being paid by the banks they rated. Imagine hiring a food critic, then telling them they'll only get paid if they give your raw chicken 5 stars. Behind closed doors, everyone knew these bundles were junk, but the profits were too good to stop and Wall Street wasn't done yet. They took those risky mortgage bundles and blended them into something even more complex: collateralized debt obligations, or CDOs. Through financial alchemy, garbage loans became investment-grade assets. But not everyone bought the hype. A few sharp investors read the fine print. They saw the cracks beneath the glitter and decided to do something crazy, bet against the housing market. There was just one problem. No one had ever created a product that allowed that. So they went to Wall Street and said, "These loans are garbage. We want to bet against them. Can you build something that pays if they fail?" The bankers laughed. "You want to bet against housing? Cute, fine, we'll sell you insurance. You pay us a monthly fee and when nothing happens, we pocket the cash. Everyone wins." It sounded harmless until it wasn't. Wall Street didn't believe the skeptics, but they loved collecting steady fees on what they thought was risk-free money. And that ease how they created the ticking bomb that would blow up the world economy, credit default swaps. These swaps acted like insurance on mortgage-backed investments. The catch? You didn't even need to own the investment to buy the insurance. It was like buying life insurance on your neighbor's grandma and secretly hoping she slipped on the stairs. The financial system became a Jenga tower built from lies and leverage, every block a bad mortgage, every layer a riskier bet. At the top, champagne and record bonuses. Ethics? Optional. Whistleblowers were ignored. Regulators slept. Executives too rich and too arrogant to stop. The party roared while the floor quietly cracked beneath them. At first, the warning signs were whispers. A missed payment here, a foreclosure there, an empty Vegas condo. But then came the wave. Suddenly, the unthinkable became reality. Home prices were falling. Wait, that can't happen. Housing always goes up. It's basic economics. For years, the market had stood like a Jenga tower of lies, leverage, and wild optimism. But by 2007, someone pulled the wrong block. Subprime loans began to implode, and the securities built on them exploded with them. Banks that thought they owned safe assets discovered they were holding radioactive garbage. AA-rated bundles turned out to be financial plutonium. We can't sell this junk. Then mark it to zero. That means we're done. Panic spread like wildfire. Hedge funds hemorrhaged cash. Investment banks racked up billions in losses. And then it happened. Lehman Brothers, a 158-year-old giant, gone. No bailout, no rescue, just a $600 billion crater on Wall Street. The message was clear. If Lehman could fall, anyone could. Overnight, banks stopped lending to each other. Credit markets froze solid. The economy's power switch flipped off. I need a loan to make payroll. Sorry, no liquidity. What does that mean? It means we're closed. Everything jammed. Families couldn't get mortgages. Businesses couldn't make payroll. Investors couldn't withdraw their cash. Retirees watched their pensions disintegrate. 401ks turned to dust. Life savings gone. Jobs gone. By late 2008, the collapse was complete. Millions unemployed. Foreclosures through the roof. Eviction notices piled up like junk mail. Soup kitchens overflowed. Unemployment offices looked like disaster zones. This wasn't just Wall Street burning. It was Main Street in free fall. And the shockwaves didn't stop at the US border. Iceland's banks collapsed. Tokyo's markets tumbled. Europe panicked. From London to Sao Paulo, economies spiraled. The question wasn't, who's next? It was, is the entire system broken? The Great Recession had begun. The US government faced an impossible choice. Let it all burn, or throw billions in taxpayer money at the same institutions that caused the fire. In October 2008, they chose the latter. I need $700 billion. For what? To shovel into burning banks before the entire thing explodes. Enter TARP, the Troubled Asset Relief Program, a $700 billion safety net for Wall Street. Why? Because the banks were too big to fail. Let them collapse and they'd drag the global economy down with them. So Washington opened the money hose. Loans, bailouts, stock purchases, anything to keep the system alive. Even AIG, the insurance giant that gambled trillions on bad bets, got $180 billion. GM and Chrysler, $80 billion more. It was financial triage on a scale unseen since the Great Depression. Meanwhile, the Federal Reserve under Ben Bernanke rewrote the rules. Interest rates dropped to nearly zero. Borrowing became almost free. And then came quantitative easing, printing money to buy bonds and mortgage debt. Think of it as patching the Titanic with 100 bills. And somehow it worked. Sort of. Markets calmed. Banks reopened. The stock market hit bottom in March 2009 and began crawling back. Wall Street exhaled, but Main Street was still suffocating. Unemployment hit 10%, 8 million jobs gone, 4 million homes foreclosed, $19 trillion in household wealth erased. Families who'd never missed a payment suddenly owed more on their homes than they were worth, and people were furious. Wall Street bonuses are back. I just got evicted. The people who caused the crash got bailouts. The people who lived through it got pink slips and food stamps. Wall Street popped champagne. Main Street lined up for soup. Then came the rage. 2011 Zuccotti Park, New York City. Thousands gathered, tents, drums, cardboard signs. One read, "We are the 99%. It wasn't just about bailouts anymore. It was about a system rigged to protect the powerful. Privatized profits, socialized losses, and no justice. No major Wall Street CEO went to jail. No handcuffs, no perp walks. Just golden parachutes and quiet retirements. Today, gold prices are soaring again, eerily echoing the same pattern we saw before the 2008 crash. Back then, it was houses that everyone believed could only go up. People poured their savings into real estate, convinced it was a safe bet. Just as many today rush toward gold, seeing it as protection against inflation and uncertainty. But when the housing bubble burst, markets crashed and fortunes evaporated overnight. The rise in gold prices now reflects the same fear and desperation that gripped the world in 2008. A search for safety in a system many no longer trust. History doesn't repeat word for word, but it rhymes. And when too many people run toward one safe asset at the same time, it often signals that something deep beneath the surface